$4,600 per year. And most retired Americans have no idea this is happening to them. That number is not a mistake. That is the average amount a retiree in one of these 7 states loses every single year. It goes straight from your Social Security check to the government. And nobody sent you a warning letter. Nobody called you. The IRS did not put up a billboard. If you are between 60 and 72 years old and you are collecting Social Security, or you are about to start collecting, this video is for you. Not for your neighbor, not for your financial advisor's other clients, for you specifically. Because what I am about to share changes how much money you actually keep every single month. You worked for decades. You paid into Social Security your entire career. You were told that money was yours. And now the IRS is taking a piece of it back, legally, by law. And in 7 specific states, the damage is even worse than most people realize. Here is what most people get wrong. They think Social Security is tax-free. They heard that somewhere, maybe from a parent, maybe from a friend at church, and for a long time that was mostly true. But the rules changed, and the IRS never made a big announcement about it. Right now, if you are sitting in the wrong state, you are being taxed twice. Once by the federal government, and once by your own state. And here's the part that will make your stomach drop. Most people do not find out until they file their taxes. By then, the money is already gone. Let me tell you exactly what the IRS can legally do. First, the federal government can tax up to 85% of your Social Security benefits. Not 85% of your total income, 85% of your Social Security check itself. This is found in IRS Publication 915. It has been the law since 1983. Most retirees do not know the exact number. Now you do. Second, the IRS uses something called combined income to decide how much of your Social Security gets taxed. Combined income is your adjusted gross income plus any tax-free interest you earn, plus half of your Social Security benefits. That formula is buried in the tax code. It is not on the front page of the IRS website, but it determines whether you pay tax on 0%, 50%, or 85% of your benefits. Third, if your combined income goes over $34,000 as a single filer or $44,000 as a married couple, the IRS automatically applies that 85% taxation rate. Those thresholds were set in 1993. They have never been adjusted for inflation. That means more retirees hit that ceiling every single year, even without getting a raise. Now here is where it gets worse. Most people do not know this because it was never meant to be simple. The tax code around Social Security was written in layers. Congress added the 50% taxation rule in 1983. Then they added the 85% rule in 1993. Neither change came with a public education campaign. There was no letter mailed to every American retiree. There was no news special on how to protect yourself. Financial advisors who work with high-income clients know all of this. They plan around it every year. They use legal strategies to reduce taxable income before it crosses those thresholds. But most ordinary retirees never hear about those strategies. Because most ordinary retirees are not paying for high-end financial planning. They are just filing their taxes and hoping for the best. And then there are the states. 7 of them make the situation dramatically worse. These states have their own income tax systems, and unlike most states, they do not fully exempt Social Security from state income taxes. That means on top of what the federal government takes, your state takes more. This is legal. It is happening right now. And if you live in one of these states, you need to know exactly what you are dealing with. Here is the first group. These are states with the harshest rules and the least protection for retirees. Minnesota is one of the most aggressive states in the country when it comes to taxing Social Security. Minnesota uses a system that mirrors the federal rules almost exactly. If your income is high enough to trigger federal taxation on your benefits, Minnesota taxes them too. The state income tax rate goes up to 9.85%. That is one of the highest in the nation. For a retiree collecting $22,000 per year in Social Security, with other retirement income pushing them above the threshold, Minnesota could tax up to $18,700 of those benefits at the state level. That adds up to more than $1,800 in extra state taxes per year. That is money that could have paid for medication, groceries, or a plane ticket to see your grandchildren. Minnesota does offer a partial subtraction for lower income retirees, but the income limits for that subtraction are low. Many middle-income retirees get no relief at all. If you are in Minnesota, you need to calculate your combined income before the year ends, not in April, before December 31st. Colorado is the second state you need to watch. Colorado taxes Social Security for retirees under age 65. Once you turn 65, you can deduct up to $24,000 of retirement income, which includes Social Security. But if you are between 60 and 64, you are exposed. The state income tax rate in Colorado is a flat 4.4%. For a 63-year-old collecting $20,000 in Social Security with a modest pension, a large portion of those benefits could be taxable at the state level. The result can be an extra $600 to $900 per year in taxes. And most people in that age group have no idea the exemption has not kicked in yet. The fix is knowing your birth date relative to the tax year. That one number changes everything for Colorado filers. Connecticut is the third state. Connecticut taxes Social Security benefits for individuals earning more than $75,000 per year or couples earning more than $100,000. Below those thresholds, Social Security is fully exempt, but above them, up to 25% of your benefits become taxable at the state level. Connecticut's income tax rate goes up to 6.99%. For a married couple with combined income of $110,000, including Social Security, the state could tax $5,500 worth of those benefits. That means an additional $385 in state taxes. It does not sound enormous, but it adds up over 5 or 10 years of retirement. If you are close to that threshold, reducing taxable withdrawals from your IRA before year end could keep you below the line. Now the second group. These states have rules that catch retirees off guard because they look generous on the surface. Kansas taxes Social Security for individuals with adjusted gross income above $75,000. Below that line, benefits are completely exempt, but the threshold applies to adjusted gross income, not combined income. That means your IRA withdrawals count directly against you. A retiree who pulls $40,000 from a traditional IRA and also collects $22,000 in Social Security could easily cross that $75,000 line. Kansas has a top state income tax rate of 5.7%. Crossing that threshold unexpectedly could cost a retiree $1,200 or more in additional state taxes. The strategy here is to plan your IRA withdrawals carefully. Every dollar you take above the threshold makes your Social Security taxable at the state level. Missouri allows a deduction for Social Security income, but only up to certain income limits. Single filers with income above $85,000 get no deduction at all. Married filers above $100,000 lose it too. Missouri's income tax rate goes up to 4.8%. For a single retiree with a small pension and full Social Security, losing that deduction can mean paying an extra $800 to $1,000 per year in state taxes. Missouri did improve its rules in recent years, but the phase-out structure means middle-income retirees often fall into the worst possible zone. Too much income to get the deduction, not enough to feel comfortable about it. Nebraska is the sixth state. Nebraska fully taxed Social Security for years, which made it one of the most punishing states for retirees. The state has been phasing in an exemption, and by 2025, Social Security income is fully exempt from Nebraska state taxes. But here is the catch. If you filed in Nebraska in prior years and did not claim every deduction available to you, you may have overpaid. And if you moved to Nebraska recently, you need to confirm your filing year before assuming you are fully protected. The transition rules matter. Do not assume the exemption applies automatically without checking the specific tax year on your return. Montana is the seventh state and one of the most overlooked. Montana taxes Social Security using its own income formula. The state does not follow federal rules exactly. Instead, it calculates taxable benefits based on Montana adjusted gross income. For retirees with income above $36,000 as a single filer, a large share of Social Security benefits become taxable. Montana's top income tax rate is 6.75%. For a single retiree with $40,000 in total income, including Social Security, the state tax bill on those benefits can reach $900 or more per year. Montana does not get talked about the way Minnesota or Colorado does, but it belongs on this list. If you live there or plan to retire there, run the numbers before you commit. Here is what you need to do right now. Do not wait until tax season. That is too late. First, calculate your combined income today. Add your adjusted gross income, add any tax-free interest, then add half of your annual Social Security benefit. Write that number down. If it is above $34,000 as a single filer or $44,000 as a married couple, the IRS is already taxing up to 85% of your benefits. Second, look up your state on this list. If you live in Minnesota, Colorado, Connecticut, Kansas, Missouri, or Montana, find out your state's specific income threshold. Compare it to your actual income. Know where you stand before December 31st. Third, consider adjusting your IRA withdrawals before year end. If you are close to a threshold, pulling less from a traditional IRA this year could keep you below the line. That one move can legally reduce both your federal and state tax bills. This is not a loophole. It is how the tax code is designed to work. Fourth, look into Roth conversions if you are under 70. Moving money from a traditional IRA to a Roth IRA creates taxable income now. But future Roth withdrawals do not count toward your combined income. That means fewer dollars pushed toward Social Security taxation in retirement. The IRS allows this. It is completely legal. The window to act may be smaller than you think. Fifth, if you have not filed IRS Form W-4V, file it now. That form tells the Social Security Administration to withhold federal taxes directly from your benefit payment. You can choose 7%, 10%, 12%, or 22%. Doing this avoids a large surprise tax bill in April. It also keeps you from owing penalties for underpayment throughout the year. These are not complicated steps, but most people never take them, because most people never learn this information in the first place. Now you have. And knowing it before December 31st is worth more than knowing it in April. If you found this useful, subscribe. Every week I cover what the IRS expects from retirees, the rules most advisors never explain. The information is here, it is free, and it could save you thousands of dollars every single year before it is too late.